As I mentioned, today we took another step in gradually scaling back monetary policy accommodation by raising the target range for the federal funds rate by a quarter percentage point, bringing it to 1.75% to 2%. We also made some changes to our policy statement, reflecting that policy normalization is proceeding broadly as we have expected. None of these changes signals a change in our policy views. For example, we removed the language stating that, quote, the federal funds rate is likely to remain for some time below levels that are expected to prevail in the longer run. Since we introduced that language a few years ago, the economy has strengthened, and the committee has raised the federal funds rate from near zero to 1.75% to 2%. As we continue to note in our statement, we expect to make further gradual increases in that rate. As a result, if the economy evolves broadly as we anticipate, the federal funds rate will, over the next year or so, move well within the range of estimates of the normal long-run level. Therefore, we thought that now is an appropriate time to remove this forward guidance from our policy statement. We continue to believe that a gradual approach for increasing the federal funds rate will best promote a sustained expansion of economic activity, strong labor market conditions, and inflation near our symmetric 2% goal. We are aware that raising rates too slowly might raise the risk that monetary policy would need to tighten abruptly down the road in response to an unexpectedly sharp increase in inflation or financial excesses, jeopardizing the economic expansion. Conversely, if we raise interest rates too rapidly, the economy could weaken and inflation could continue to run persistently below our objective. The committee's gradual approach is reflected in participants' projections for the appropriate path for the federal funds rate. The median projection for the federal funds rate is 2.4% at the end of this year, 3.1% at the end of 2019, and 3.4% at the end of 2020. By 2020, the median federal funds rate is modestly above its estimated longer-run level. These projections are very similar to those made in March. Although the median federal funds rate edged up this year and next, most participants did not revise their projections. And I'll conclude by mentioning two additional matters. First, our program for reducing our balance sheet, which began in October, is proceeding smoothly. Barring a material and unexpected weakening in the outlook, this program will proceed on schedule, and our balance sheet will continue to shrink. As we have said, changing the target range for the federal funds rate is our primary means of adjusting the stance of monetary policy. And finally, as discussed in the minutes of our May meeting, we're making a small technical adjustment in one of our tools for implementing monetary policy. To keep the federal funds rate in the target range, we rely on the rate of interest on excess reserves, or the IOER rate. Up until now, we have set the IOER rate at the top of the target range for the federal funds rate. In recent months, the federal funds rate has moved up toward the IOER rate as short-term interest rates have risen more generally. So to move the federal funds rate closer to the middle of the target range, we are now setting the IOER rate 5 basis points below the upper end of the target range. This minor technical adjustment has no bearing on the appropriate path for the federal funds rate or financial conditions more generally. Thanks for listening, and I'll be happy to take your questions.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.